Hey guys, how's it going? It's Andy from Magoo Investing. Happy Monday. It's crazy to think that we are getting close to December. Tomorrow is going to be the last month of the year. And so I'm going to wrap up this year talking about some major changes that I've had to my investing portfolio. Today's video, I'm going to be breaking it down into three different parts. The first part is I'm going to talk about the two cheap stocks that I've added to my portfolio in the past month and kind of explain why I've picked these two out of the 20 plus stocks I've talked about in the past month. Part number two of this video is I'm going to talk about what my overall stock portfolio looks like going into December. As I mentioned, this is a huge change to my overall portfolio considering one of my biggest positions in Sonos, which was around 50% of my overall portfolio, got taken from me in the past month. So I have some major changes there. And then finally, I'm going to be talking about how my investing strategy is going to change going into the last month of the year, because I think we're going to have a really interesting end of the year, and I want to talk about some of the historical numbers that make me feel like something specific is going to happen in the stock market and how I'm planning to take advantage of that going into 2021. Just a reminder that if there's any stocks that you'd like me to talk about in a future video, be sure to leave them in the comments section down below and I'll get to them as soon as I can. Before we get started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I really appreciate it if you hit that like and subscribe button. It also would help my channel out a lot. If this video gets to 75 likes, I will shave off my mustache, so you guys don't have to keep commenting about it in the comment section down below. So as I mentioned, I've had some huge changes in my overall stock portfolio, and that mainly came from Sonos being taken away from me. I had an option position with Sonos that accounted for around 50% of my funds in my portfolio. And in the past month, if you've been around this channel for a bit, Sonos skyrocketed in price after having a fantastic earnings report that saw the stock go from $15 to $20 in just a couple days. And since I had a covered call that was at the $15 mark, I missed out on a lot of additional profit and was forced to sell at the $15 strike price. What that does mean is that I had a lot of cash sitting on the side. And so the majority of the second half of November was talking about cheap stocks to buy because I wanted to get some great deals going into 2021. When I talk about cheap stocks, I'm talking about stocks that I think of as being on a discount, not just price-wise. It just so happens that both of the stocks that I did buy for my cheap stocks are relatively cheap in price. So the first stock I bought was around a week ago, and that stock is going to be General Electric, ticker symbol GE. And so some people have some mixed feelings when it comes to GE. GE was a stock that I really disliked at the beginning of this year, but doing some more research on it in the past couple months, I've started to kind of change my tune about it. And so right now, GE is trading for $10.25, and it's down 8% on the year. This was a stock that has been, in my mind, pretty horizontal for a long time, but in 2020, it has bounced around a lot. It bounced back from its lows of around $6, and it's done very well in the past couple months. So instead of buying just straight shares of GE, I decided to use my wheel strategy, which is something that I've been using and talking about in videos for the past couple weeks. The beginning of the wheel strategy means that you sell a put on the stock. So what I did with GE trading at $10.25 and down 8% on the year, I sold a put at the $10.50 strike price that expires in 18 days. What this means that if in 18 days the stock is below $10.50, I will be forced to buy 100 shares at that given price. This means that if the stock skyrockets and it's like $12 in 18 days, I will not be forced to buy at that price, and I will just be able to keep the premium. But if the stock does fall and it stays below that, I'm going to be forced to buy no matter what price it is right now. The best case scenario is that in 18 days, the stock is going to be at $10.49 and I get to buy the shares at $10.50. And since I was paid 45 cents a share for it, I will be at a profit considering my average price will be down at $10.05. So the beauty behind the strategy is no matter what happens to the stock, I'm going to be pretty much happy. Instead of just buying straight shares, I get to lower my average price if I do get assigned these 100 shares. And so since I am very long-term bullish on the stock, I win no matter what in my opinion. It does kind of limit some of the upside potential if the stock does skyrocket, but I'm not betting on it to skyrocket anytime soon. I think there's going to be a more long-term play. And so the reason I picked GE for this is because my tune on GE has changed a lot in the past couple weeks. GE is one of these stocks that I call reopening stocks that'll do well when the overall economy and things start to open up fully. This is why I bought into stuff like Southwest Airlines and Planet Fitness. These are stocks that have been pretty beaten down in 2020, but they've done well pretty recently as we've had some very positive vaccine news. And I think of GE as being a very similar thing because their most profitable part of their business comes from the aviation. And so from their last earnings report, their revenue from aviation dropped 39% as 26% of the global fleet of planes are grounded. And so you do get the benefit of the reopening when it comes to GE, but the main reason why I've identified GE as being one of the stocks that I wanted to put my money where my mouth was has to do with renewable energy. This is something that I strongly believe that renewable energy is going to be one of the most exciting industries to be a part of in the next 5, 10, 20 years. And GE seems to be in a very good position to take advantage of that. 2020 was supposed to be a record year for wind turbine installations, and as I mentioned, GE has already shown that they're in a very good spot to take advantage of that. Even with the pandemic and some of these spending numbers decreasing, the number of installed wind turbines for 2020 was only 6% less than they expected. So even though there's been a kind of a stoppage when it comes to spending for a lot of different areas, only a 6% drop is better than I kind of expected. They've already won a deal with Lithuania to install 22 wind turbines, and they will be providing operational services on those locations for 25 years. So they're starting to win some of these larger contracts. This industry is going to continue to expand in the next couple years. From the numbers I found, by 2024, the total wind power installations are expected to rise by 54% compared to what we saw in 2019. So as I mentioned, this is more of a long-term position. I don't think this is a stock that's going to have one good earnings report and it's going to skyrocket, because even before the pandemic, this was a stock that was sliding. But I do really like the long-term potential of the stock based off of the positives that I'm seeing from the reopening process, because their aviation, which is their most profitable business, is expected to get back to somewhat normal in the next couple years. And then the long-term potential of the renewable energy just has me really excited. I think that GE is at a great deal, because I would call it cheap because it's at a significant discount compared to where it was a couple years ago. The company has had a lot of problems. They've been cutting a lot of costs, which is what I really like to see with a struggling company. And they've been selling off some of their businesses. And I'm a big fan of GE focusing on renewable energy, because I think this is an industry that's going to be backed by a lot of government. I think this is an area that governments are going to be willing to spend a lot of money to upgrade their energy in the upcoming years. So I'm very excited to see what GE can do with renewable energies in addition to the reopening process. So let me know what you guys think about General Electric, ticker symbol GE, in the comment section down below. So the next stock that I bought from the past month is going to be Zynga, ticker symbol ZNGA. Currently Zynga is trading for $8.22 and it's up 34% on the year. If you've been around this channel for a bit, this is a stock that I held for probably 6 months in the past year. It was a stock that I identified as being a pretty good deal and a stock that I thought would do very well during the lockdown process. And I was pretty right about that. But I did end up taking profits on it a couple of months ago. And based off of the last earnings report and some of the news that we've seen with the vaccine, I thought this was a great deal to take advantage of. As I mentioned, this was a stock that did very well during the lockdowns. And pretty much any of those stocks that did well, when you have any of the vaccine news, they kind of sell off, because a lot of the attractiveness to some of these stocks that are up significantly this year is the fact that they'll do well if people are staying at home. I believe that Zynga is going to do well pretty much no matter what, and being able to buy it at a discount, beautiful. Similar to what I did with GE, I ended up selling a put on Zynga. And so it's at $8.22, and I sold it at the $8 strike price that expires in 24 days. What that means is if Zynga on Christmas is below $8, I'm going to have to buy 100 shares of the stock, no matter how far it's fallen. But in exchange, I was paid 24 cents a share, meaning that this would be a 3% trade for me if the stock is above that price on expiration date, and it's a win-win, just like I said with GE, pretty much whichever way it goes. This is a stock, instead of just buying straight shares, I'm being paid 3% to be a little bit more patient, and I miss out on some of the upside potential if it skyrockets. But from what I'm seeing, I think Zynga is going to be a great long-term position for me, and I wanted to take advantage of some of the cash that I had sitting in my portfolio to buy into Zynga. So Zynga is a mobile games company that has done very well in 2020. Even with that, I believe the stock is at a significant discount because of some of the recent price movement and the fact that it hit $10 just a couple months ago. It's a mix of the stay-at-home stock selling off, as I mentioned, and some underwhelming earnings that I didn't think were actually that bad, and I think people were taking profits after an incredible 2020 that the stock has seen so far. So they saw a 46% increase in revenue year over year, and their guidance for revenue growth was only 41% for the next quarter, which is lower than Wall Street kind of expected. But 41% for revenue growth, I will take that any time. So I believe this is the type of stock that has kind of had unrealistic expectations put on them because they get categorized into these stay-at-home stocks. And since that sell-off, 41% revenue growth for the next quarter, I will happily take that. So I was able to buy it at a discount. And so the most common price targets that I've seen for Zynga in the past couple weeks have been at the $13 to $14 range, which is significantly higher than where we are right now at $8.22. So there's a lot of upside potential, and I see a lot of positives with Zynga. The company did have a net loss of $122 million, but that was based off of a lot of acquisitions that they made in the past year. And the company is still net cash flow positive at $108 million for the past quarter and $300 million for the previous 12 months. They've seen a 23% increase in their monthly average users, and that's the growth that makes me feel very confident for a long-term position. It has slid off of their all-time highs, but I think this is a stock that's going to do well in the next year, 5 years, 10 years. So I love Zynga, and I was happy to buy it at a discount. All right, so let's talk about how my portfolio looks for part 2 of this video. The first chart that I'm going to show kind of tracks how my percentage gain for my portfolio has done to the S&P 500. Yes, I could pick the Dow or the NASDAQ, but I think the S&P 500 gives a better representation of the overall market, so that's why I picked that. So as you can see, my portfolio, which is in blue, was up 6.7% in the past 30 days compared to the S&P 500 being up 7%. And you might be wondering, you underperformed compared to the overall market. Why wouldn't you just buy into the overall market and just kind of take that 7% gain? And the reason I'm very happy with how my portfolio did in the past month has to do with this. So let's talk about what my portfolio looks right now. The main thing that I want to point out is that I was almost able to outperform the market with 36% of my portfolio being in cash. So I had a lot of money sitting on the side, and the stocks that I did own did very well and was enough to almost beat the overall market. So let's show how my portfolio has changed in the past couple months, because I do still have the pie charts from the past 3 months. So in October, I was only in 5% cash. That's when I ended my Zynga position that resulted in me being in 22% cash going into November, and 40% of my account was being tied up in Sonos. As I mentioned, a lot has changed since that point, so I want to put up the breakdown of what my portfolio looks like currently. Cash is up at 36%, and a couple weeks ago it was at 65%. So I've reallocated a bunch of that cash, but I'm still sitting very heavy in cash going into the end of 2020. And so the rest of my portfolio has remained pretty much stable. I haven't done a lot to it. A lot of the blue chip stocks that I've had have remained stable, and they've just been chugging along. I like to keep a decent amount of my portfolio in cash so I can sell options and take advantage of high IV. And that's kind of where my portfolio is sitting right now. So let's finish off the video talking about what my plan is for investing into the end of 2020 and going into 2021. So 2020 has definitely been all over the place for the stock market. We had the longest bull market in history that was snapped based off of the stock market crash that we had back in March. Then we had the shortest bear market in history, and now we've been chugging along ever since that point. Even with that crash, the tech-heavy NASDAQ is up 35% on the year, which makes it as high as we saw in 2019, and we haven't seen that good of a year since 2013 when the NASDAQ jumped 38%. And I expect to see kind of what we saw at the end of 2018 at the end of 2020. And so for people that weren't around, 2018, the December months was a crazy time. At the beginning of the month, we had a lot of the trade war stuff with China where a lot of the tech sold off. Then we saw some bounces back. Christmas Day was like a 5% gain for the stock market, followed by a 5% crash the next day. That was a really interesting time because that was the first time that I've seen tax losses in action. The whole idea of a tax loss is that you're kind of manipulating how much money you're making for capital gains to put yourself into a lower tax bracket. And so people at the end of the year, they have tax benefits to losing money. And so for people that have had very good years, taking a loss can be actually very beneficial to their overall tax bill at the end of the year. And so that's what we saw at the end of 2018, where we saw a record number of selling. And I think going into the end of this year, I think we might be able to see, if the stock market slides a little bit towards the end of the year, a lot of selling pressure as people try to lock in their gains for the year, especially going into 2020 when we have really no idea what's going to happen. And so I expect the market to sell off at some point, maybe like a 3, 4, 5% move in a couple days. Is that going to be a crash? No, but it gives some decent opportunities. And so I'm keeping myself very heavy in cash to try to take advantage of that. And the stocks I'm going to be targeting are going to be the blue chip stocks, stocks that I already own like Nike, Apple, Microsoft, and I want to buy into more of those to kind of keep myself a little safer going into 2021. These are stocks that have done incredibly well in 2020, and I think they still have upside potential, but I do want to be able to buy them at a discount and give myself some time to see where the overall market is going towards the end of this month. So I think December is going to be a really interesting month. I think we're going to see a very nice bull run going into the end of the year, and then I think we're going to see some selling off going into 2021. And then 2021, who knows? It's probably going to be as interesting as 2020 was, but I've had an incredible year, and hopefully you guys have had a very good year for your stock portfolio. So let me know what you guys thought about my changes to my portfolio, and let me know what stocks you guys would like me to talk about in a future video. Thanks for watching. I appreciate all the support, and I will see you tomorrow.